Hi and welcome everyone to a real wintry edition of the JMI Wealth Monthly Update. And I think I informally introduced winter at the last update, and we're now embracing the season in all its many facets. It's windy and raining up here in the north and cold and snowy down south, so I'm told. But those sort of balmy and favourable tailwinds that I talked about last month have continued to push share markets higher. So there's a small ray of sunshine there for us all to welcome. So June was a positive month for share market investors, and nowhere was that highlighted more than in some of the offshore markets that we monitor. And if we look at the global share market index, it rose 5.4% over June. Now, when you translate that return into New Zealand dollars, it does fall a bit to 3.4% because the New Zealand dollar actually gained ground against the US dollar over the month. Some of the other US share markets were even stronger. The benchmark S&P 500 index, it delivered a total return of 6.6% in June, and the really tech-heavy NASDAQ index went up by a similar number, but the NASDAQ has now rewarded investors with a 39.4 total return so far this year, and that's courtesy of some pretty startling returns for some of the mega cap tech and online stocks like Microsoft, Apple and Amazon. We do have to put that in a little bit of context though, because the NASDAQ index and many of those real mega cap stocks really suffered in 2022. The good news though is that many of them have recovered all of that ground that they lost last year. Now, closer to home, Australasian markets, they're also in positive territory so far this year. The returns are a little more subdued than the US market, but they're positive nonetheless. And one of the key features so far this year has been a positive contribution to investment portfolios from fixed interest products. Now, last year was a challenging year for investors in low risk portfolios. We often refer to these as conservative portfolios, and they're characterized by having high allocations to fixed interest products. But that sharp and material rise in interest rates last year meant those products delivered negative returns to a degree we haven't seen for a long time. And of course, particularly noticeable in those portfolios with a lot of fixed interest product. This year, however, despite the continued pressure on official cash rates around the world, longer term rates, 3-5-year rates, have stabilised, and in some cases they've actually fallen. So yields are higher and fixed interest products are delivering positive returns. Now, taking a bit of a step back, financial markets are still really trying to settle on forecasts for inflation, and the degree to which the monetary policy action taken by central banks so far has restricted economic activity, and also the potential flow-on effects of that reduced economic activity for corporate profitability. Not only that, but also how much more central bank action may be needed before we can really be sure that rising interest rates are in the rear vision mirror. And on that note, a number of central banks have hit the pause button. Here, the RBNZ, the Reserve Bank of New Zealand, it's sitting back to see if the 5.5% official cash rate and the very speedy manner in which we got there have done enough to reduce demand. And in the US, the Federal Reserve has taken a pause, or they're calling it a skip, as it's been referred to, but they've also signalled that there's a good chance that they'll add 50 basis points more to the current level of their cash rate. But look, in general, the tone from a lot of central banks has been that if more hikes are necessary to dampen inflationary expectations, they will happily oblige. Now, news in New Zealand is that we've officially entered a recession. So that means we've had 2 consecutive quarters of negative GDP growth. Now, it's very possible, though, that future revisions could push that first quarter growth, the first quarter GDP growth outcome, which showed growth fell by 0.1%, we could see that revised into positive territory. But regardless of whether GDP growth is minus 0.1 or plus 0.1, with one of those outcomes signaling recession and one not, it doesn't hide the fact that despite that, growth is anemic. And it looks even worse if you look at it as growth per capita, per head of population. So the state of the local economy is a great topic to debate at the moment, because it really depends on whether you're a glass half full person or a glass half empty person about how you interpret the current data. Earlier this month, the government released their government accounts for the 10 months to the end of April. Now, these show quite a worrying trend in company tax take. And the word from business is that margins are being squeezed, that's affecting profitability, and the tax take numbers seem to bear out that observation. We've got GST and PAYE receipts are also lower than expected. Electronic card transaction data for May were weaker than expected. Card spending actually fell in May compared to April. And the glass half empty brigade will also note that food prices continue to climb, and food price inflation has now climbed over 12% in the last 12 months. But if you like your glass half full though, you'll point to the housing market, which is showing signs of life, very much sort of stabilising. It's not surging to the top side, but the sentiment does appear to support a bit of a plateau in house prices at current level. So it's very much a mixed picture, and we saw that actually. That was evidence of the ANZ Business Outlook, which was released recently, which showed that business confidence has bounced back. Look, it's still at really subdued levels, but the RBNZ calling a halt to rate increases recently does seem to have been noticed by business people. Now, as I pointed out last month, we've increased our portfolio exposure in our model portfolios to global shares, and that stance has so far been rewarded as markets have sort of kicked on. We've also had a larger than usual exposure to global fixed interest products, as we believe that central banks will eventually win the battle against inflation, and we're still holding our portfolio exposure to listed property below our long-term strategic positions. So if you have any questions about, say, our managed fund options and how they could be used to satisfy your investing requirements and grow your wealth, please do get in touch with us. You can do that through our website, through Facebook, LinkedIn, Instagram, and I look forward to catching up with you next month.